The last decade has seen an explosion of a new type of company in the mining space: royalty companies. Royalties are nothing new to mining, they've been around for a long time. The archetype of this type of company is called Franco-Nevada, which in the 1980s started buying royalties on various mining operations. A royalty on a mine is no different to the more common types of royalties you might be familiar with, like on a piece of music or movie. In mining, a royalty is owning a small percentage, usually 1 to 2% of all future earnings of a mine, as long as the mine is in operation. There are other complications with these deals, but in the simplest forms, that is a mining royalty. There are other complications in this type of deal, but in the simplest form, that is a mining royalty. It is one of the ways that people can take advantage of the long-term value that a mine can provide without having to build and operate a mine themselves. Recently, royalty companies have been innovating by getting into a new form of financing called streaming. Just like everyone else, I guess. For a deeper understanding of royalties and streaming, our guest on this episode is Shaun Usmar, who in 2016 started Triple Flag Precious Metals. Come join us and let's explore. So Shaun, welcome to Exploration Radio.
Thanks. It's good to be here.
So before we get into it, Shaun, do you want to give a quick introduction to yourself and explain how you got to where you are right now?
Yeah, it's been a few years now. I started off graduating in engineering as a metallurgist in South Africa. Worked for a number of years in the steel and aluminium sector as a metallurgist and a production engineer. And then I was really lucky. I got a national scholarship from a mining company called Gencor at the time. Did my MBA at Northwestern at Kellogg and worked on deals in everywhere from China to Colombia to Australia. Worked on the BHP Billiton merger as well as the integration, which was a great experience. And then Mick Davis, who was CFO of Billiton, and was due to be part of the enlarged group, left to found Xstrata. And I was fortunate to be one of the sort of 7 early executives to join him with that in the basement of JP Morgan's offices on Embankment in London. Small company, I think we're $500 million. And you'll recall it was a very acquisitive business. I think within our first year, I was held up in Sydney in a data room. We ended up acquiring MIM. We doubled the company and carried on in that way. So I think within 5 years, we started prior to the super cycle, but within a short period, the business was like 60 billion in market cap. And, that took me in different roles. I co-headed M&A, went to South Africa to sort out some of the empowerment deals in the alloys business, as CFO, and then came to Canada when we did the hostile takeover of Falconbridge, thinking it would be 2 years, and I just celebrated 16. I love Canada. It's a beautiful place. I've lived in 5 countries. Didn't want to move to Switzerland and join there. Ended up taking on a little later the Barrick CFO role at a time when that business really had a bit of a tough time. Gold was going down at about 13 billion in debt on the balance sheet. It had lost money for 3 or 4 years. And particularly with the integration and restructuring skills of Billiton, I felt it could make a difference. And that's pretty much what we did within a short time, like reset the cost structure, got it to make cash when gold had dropped to 1050 and reset the mine plans and worked with a really good team of people there. And then I was approached really by Elliot out of New York to see if I wanted to start the business I've started with them as a capital provider, and kind of the idea that, there's an opportunity here to really build a business from scratch, clean sheet, with a sophisticated, really patient form of capital, which I think is important in the mining space, with a lot of naysayers and skeptics. But 6.5 years later, it's been a great journey. So I love this industry, and it's been a great adventure.
There's a lot of things that you mentioned there that we want to dig into, but I want to talk a little bit about, it seems like there was a lot of people in Billiton that really learned that skill of how to take an asset and restructure it, reset it up. I was on the BHP side when the BHP Billiton kind of thing combined. And I found, I think, that was really a skill set that kind of was brought into BHP when BHP and Billiton combined, in that I always felt like, BHP had great assets, like squidginess around those assets because the assets were just really good. Whereas Billiton had these assets where, you really needed to kind of be on top of those assets. Otherwise, they could just spiral out of control and just kind of blow the company up.
Yeah, it's an interesting one because, you're going back in the time machine to sort of 2000, 2001. And if you think about it, that time, if you go back even further to the DNA of Billiton and really Gencor, the original strategy, I think, was by one of the former minister of finance, a guy called Derek Keyes, who got together this young swashbuckling group with, Gilbertson, Deb Monroe, Mike Salomon and Mick Davis and others. And it was firstly recognizing that if they wanted to grow a world-class mining company, you had to get out of the exchange controls in South Africa. And the assets they had at the time were, deep level gold mines. They certainly weren't sort of the quality and tier that you just sort of mentioned with BHP.
Mm-hmm.
But you had a group of very sort of young, ambitious, I think quite entrepreneurial people with an organization that wasn't overly burdensome with bureaucracy and hierarchy. They identified the Billiton transaction. It was well timed with hindsight. But I think to your point, I think if you listen to the strategies of most of the diversifieds at the time, it felt a little like a unicorn hunting exercise. Everyone's looking for first quartile, like long life, so on and so forth.
Exactly.
And I think the whole moniker around value creation was getting lost. Because remember, there was also a period where the sector, I think, lost a bit of its way. We'd had these periods of real declining prices. The sector really not created any shareholder value for a very, very long period of time.
I mean, that period of the late 80s to the 90s was like a disaster for return on investment in mining.
Completely. And also really hard to attract talent, right? I think it's a problem today, but it was a real issue. So you had a group of guys who would look critically at not just the opportunity with, resetting these assets, reducing cost structures, proving up more reserves. How do you actually create return on capital and return on investment at that point? But also the softer side, because very often a lot of these organizations, and still today I see it, are quite siloed. And if you have the same teams, the same skills, the same management people, very often you just delayer it. You actually push down accountability to where the money's made at the operations, and you do that well. It's amazing what you can achieve. And just make sure that you do a really good job with governance, capital allocation, and so on and so forth, and talent attraction. It becomes quite self-fulfilling. Because if you remember that time, like BHP always had these beautiful assets, but the merger at the time was this idea of this really energized team on the Billiton side, and then with these wonderful assets on the BHP side. Because BHP had stubbed its toe, I think, at that time on HBI, Magma Copper,
correct,
Octedi, Hartley. So, it was pretty tough. And I think bringing those two together, the culture and re-energizing it, was part of the proposition.
It's interesting because I think it was one of the few kind of mergers where it wasn't really about the tangible assets of the two companies kind of combining. It was about the management ethos on one side and the physical assets and how the combination of those could actually become a much bigger company and better company. And the proof's kind of in the pudding that the company did become a much better kind of behemoth on the other side of it.
I think that's right. And all these businesses over time centralize, decentralize, do all these things. But in many ways, as you say, a lot of the individuals that were involved there then have gone on to do different things. And for me, that was part of the appeal with Xstrata at the time, was just a chance to work with Mick in creating something almost from scratch. And in many ways, it's what prompted me to leave a pretty good paying job at Barrick as CFO to start this business. It's just the opportunity to build something from scratch.
Now, in hindsight, you look at it, the meteoric rise of the company was obvious, but did it feel like that when you were kind of inside the company?
It never does. People write these stories with hindsight, right? And then it all looks quite simple. I think when we started, at the time, I remember watching the share price going down. We were drawing charts on the whiteboard around, okay, if we look at the usual thing of say net asset value per share over time as a proxy for share price, and then the aging with reserves. And the question we had is what would it take to sort of double the share price, at least on a constant, price basis? Because there's this big gap. Once you layer in projects and other things, you've got a gap. And, we were very active, obviously, at looking at different opportunities. But I know from starting this business as well in the beginning, there's only so many institutions give you the time of day. There was no super cycle discussion at that point. I think even when we did the MIM transaction, because I just led a small deal in Germany on a smelter called Nordenham, went across and we'd looked at PGM opportunities and a ton of other things at the time. But as we started working on MIM, it was, I think there were a lot of mining companies who were pretty scornful about the asset quality and the asset base. And once we had done it, we had integrated it. I lived in Brisbane for 3 months or so, integrating part of the business. And you just done the simple things, sort out the corporate office, make capital available, reorient it, and debottleneck the businesses. Suddenly, value was created. That was a huge launch pad for the business for what was to come. Mixed philosophy. You had a couple of just simple truisms that have stayed with me. The ability to ensure that ultimately, simple things. You'd say, look, I'll never fire people for making mistakes. I'll fire them for hiding mistakes. Pushing down that accountability to the sites, making sure that you've got a very simple, transparent overlay between the sites and the office, that the money ultimately belongs to the corporate office's capital allocators, tax structures, things like really an EBIT model. A very small group of guys at the corporate office who challenge each other, are really high functioning, and people that, just sort of make you a better version of yourself to be around. It's a very empowering environment, not bureaucratic at all. I loved it.
I think that was one of the things that I think really separated Xstrata when it kind of grew, is that you guys did a lot of stuff in that time. And some was great, and some were mistakes. Like in hindsight, you could have done them differently, and some were kind of somewhere in the middle. But I always find it funny when people like, oh well, like Xstrata made all these mistakes, and like, well, like that's part and parcel of doing a lot of things, because you're not going to get all of them right. You're just hoping that more are right than the ones that you get wrong at the end of the day.
I think it's true in mining, and I think it's true in anywhere. The problem in mining very often is some of the mistakes can be so expensive and catastrophic. But we're all in the business of making judgment in the face of uncertainty and taking calculated risk. And, you look at it with a very different sector with Musk and SpaceX as an example. I think the reason he's been able to innovate is he's not afraid ultimately to deal with failure and to iterate, to learn, and to be able to move forward. And I don't know about you and your personal investing environment or elsewhere, but I know we all would like to think we could pick winners, but certainly I don't do it personally. I haven't met a group yet that do. Hopefully, on balance, you do a much better job of making good decisions, and then the world turns out to, hopefully not throw too many curveballs at you. But I think that that earlier point about it's okay to make mistakes, just want to make sure that you're not hiding them.
Like pilots have this ability to kind of talk about their mistakes, and if they talk about it, they don't feel any career ramifications, but if they hide it, they feel career ramifications. And so so the whole industry kind of learns from all the mistakes of all the pilots. And I think we're sometimes a little bit guarded about that, because we think that's going to be the career limiting move because I made this mistake.
I think it comes down to the importance of culture, though, in any organization as much as anything. Like if you can think of your favorite sort of mining conglomerates or whatever, where if there's either a culture of fear or blame apportionment, as opposed to sort of being able to say, okay, like this has happened. How do we triage? How do we support the guys on the ground dealing with things? Because it's very seldom, at least in my experience, that you got people turning up to work to figure out how they can do bad things, right? People want to do a good job. So if you assume that as a premise, and you assume that you're hiring sensible people, or you're not doing a good recruitment job, then why would you spend so much time to not empower them to do the right thing and to work with them when things don't go to plan?
I think that's the phenomenal kind of like aspect, is that the culture would override like any kind of like ability or inability people feel about what's going to happen to their job. So if you can kind of get that cultural piece right, then like surely no one would be, or people would be empowered to kind of talk about the good, the bad, and the ugly. And then there's plenty of that, right? Like this, like, and I think this it's to your point that you kind of mentioned, is that like ultimately, if you think about mining as an industry, like most miners are price takers, they're not price setters. So ultimately, there's a certain fundamental part of the business that is always out of your control. So there's always some level of uncertainty attached to it. And so, like you could be conservative and have a small level of uncertainty, or you could be aggressive and have a high level of uncertainty. But, like at some point, you're going to get that probability game wrong, and you might have to pay a price for that.
I think that's right. And, I think back to our experience when you go back to 2007-8, when Lehman's collapsed. And, I know in Xstrata at the time, what was a business, I don't know, we were probably doing 25 billion EBITDA back then. Our nickel business had just done about 2.5 billion shortly after the acquisition. Nickel had gone to nearly $25 a pound. By the time Lehman's had collapsed, it was 1050 on its way down to 4. And, a sensible level of gearing just 6 months prior suddenly becomes like really problematic, which I know from my Barrick experience, like the ultimate risk mitigant, I think, in the mining space for markets that you can't control, because you're right, there's price takers. Sometimes when those things happen, you can't deal with the unforeseen and cut costs and do everything without actually potentially really, impairing your business. So you need liquidity. And that's why I'm not a big fan of debt in a business. I know there's an efficiency to it in the capital structure, but when things don't necessarily work out according to plan, or there's a market adjustment, and I know we like to think that those don't happen very often, but go back and look, they've been happening more often. It's like weather events.
Why were you interested to kind of move to, like something outside of kind of the traditional, mining company space?
I suppose one, I've always had a sense of curiosity in this space. I've had the good fortune of working in that sort of environment, as you mentioned, in the Billitons and others. And, we originally, I think even in 2000, although now I only realize with hindsight, we were actually starting to play around with things around the volatility of pricing in a diversified, how actually quite low and undemanding the multiples were for $1 of earnings or EBITDA or cash flow compared to, say, gold companies trading in Canada at the time. And the question was, if you could actually bifurcate some of those cash flow streams, could some of them be more valuable to certain investors than others? And in so doing, actually unlock value for shareholders, your shareholders in the process, as opposed to trying to be all things to all people or attract this sort of traditional conglomerate discount. So we were toying with those back then. The first time I saw the streaming and royalty model through the eyes of a diversified was actually when we bought MIM. One of the assets in that mix was Alumbrera, and Charlie Sortain had just turned that asset around.
Yep.
Jan Telfer had flown to London at the time to sort of see, because this copper asset, he wanted to stream the gold. And, we would trade it, I don't know, 4 or 5 times EV/EBITDA multiple. I think if he wasn't as cheap on his offer, we probably would have done it back then. But it was, it was an interesting thing to see that this gold that was just a byproduct credit, and wasn't really a core focus for us, really had value to others. And then Barrick, when I was looking to restructure, when you're sitting in the seat, and it's a thing that's really informed how we compete, because you're right, there's quite a lot of new entrants that have come into the space, in the streaming and royalty space. But I think you got to bifurcate it and choose how you actually strategically compete.
And what's your competitive advantage, right? What are you going to hang your hat on?
Exactly. So I think for us, firstly, having sat on the other side where, you got 13 billion in debt, you've lost billions of dollars in cash flow in prior years. My all-in sustaining break-even that wasn't public at the time for 15 would have been 1,700 gold when gold was going to 1050. So we would have shed another $1 billion of cash in 15 alone if we hadn't reset that business. But at the same time, if gold's down there and you're trying to sell assets, you're selling EBITDA and you're selling optionality, and it's usually at a bad time. You can't issue equity because your equity is under pressure. It's super expensive if you can. You don't want to do more debt because you're going sub-investment grade. If you're selling assets, you've got to make sure that you're not making the situation worse because you're selling EBITDA. So as part of that restructuring, we actually ended up doing a stream for 610 million on a Dominican asset called Pueblo Viejo. And it allowed me to see firsthand that, one, just how well you can structure these things, two, the sort of competitive cost of funding. But three, really that it's, even though there's a perception of hyper competitiveness, I think, in the space, it really isn't. There's only a few guys, there were really 3, that had the firepower to write that check, who had the technical, commercial, accounting, and other capabilities to structure the deals in a sensible way and deal with rating agencies and so on and so forth. And we'd done that on the other side. And so there was an insight. And I think to your point on competitive advantage, I wasn't looking to do this at the time, but when I was approached somewhat repeatedly, I finally met up with the Elliott guys who I didn't know. I was really impressed with what I saw. And, they don't invest in mining as a rule, but they do like precious metals as part of their portfolio exposure. They have an infinite time horizon. And I think in the mining space with our time horizons, that's actually really important, because a lot of resource funds, the guys maybe invest in 4 years and exit in 2 or 3 or something. So the cycle,
That's right.
yeah, the cycle may or may not be in your favor. And I think it can drive the wrong behavior for your investors. So the founding idea at the time was, on my side, I saw two opportunities. The first was, having had the experience both in the diversifieds, which is most of my career, but then in precious with the Barrick experience, that conventional forms of funding were becoming more and more scarce and unreliable to the mining space. I think Australia is almost a bit of a microclimate to itself, where the markets have been quite supportive on a sustained basis. But
yeah, it's a lot more of a micro economy
yes,
here. Like, the money kind of stays in
yeah,
and then it comes out, and it's a more of a closed system. Whereas I think North American markets tend to be a very, very different system in that sense.
I think that's right. It's the same with London. So I think increasingly there's a question of relevance. For the miner, there's a question of access. Same with debt can often be from a risk point of view quite problematic and also quite expensive, and particularly tough for single asset businesses or developers and so on and so forth. So the idea was, if we had originally as a private company about $1 billion to deploy with Elliott's firepower, they would allow us to compete not at the small end where the barriers to entry are lower, but at the large end with the big guys. Build a team from scratch. We felt there wasn't a scarcity paradigm, which I think a lot of people had. I thought there was more need for this form of capital and it wasn't well understood. And that really there's an actual symbiotic relationship that you can create if this is done well, because you can't have a winner and loser. So look to compete directly with those guys, really precious focused, check size typically $1 to $500 million in size. And then we thought if we were assuming in our business plan about deploying about $1 billion over 5 years, and then we'd transition to the public markets, broaden the asset base and move on. And we said we wanted to target cash generating or near cash generating opportunities primarily, where there's significant optionality, but you create the flywheel of cash flow that you can reinvest. You can pay dividends, but you can reinvest. So you have something that works for mining companies, and you're focusing very carefully on the right partner, on ESG, how you can actually complement that, and at the same time creating a good investment class, a really good precious metal investment class for investors as well.
I think you've done a really good job of kind of like explaining why the streaming model really works for both sides, like investors as well as companies. But let's take like a step back. So for the layman person out there that doesn't know streaming aside from what they do on Netflix, like what is kind of like the principle of streaming? Like, what is the basis of it?
I'd sort of look at, typically people talk about royalties and streams as a bucket, and we've got both in the portfolio.
Mm-hmm.
Look, I think on the smaller end, most you'll see those businesses will typically accumulate royalties. Royalties are usually a share of either the product or a share of revenue or profits, essentially, usually secured on title. It does vary by jurisdiction, but often these things are struck at a time when a deposit is discovered. There's it's not very large in value at that point in time, and then obviously as the deposit grows, becomes a mine, and hopefully becomes something very valuable, those things can become very valuable. So the best and most recent example, I mean, you've seen Deterra and others, but we saw there was a transaction that Rio did on the Cortez royalty. It was one of the assets that was in the portfolio of Barrick. They went for over $500 million. I can tell you it wasn't worth that, obviously, when they struck it back in the day. So you'll see guys accumulate those, and I think for mining companies, a lot of them have got a lot of these that, frankly, they don't even know they have. The others will come and tell them they've got them. So they're so below the radar screen. It just has no value recognition for their investors, and it isn't something, if they created their own sort of royalty portfolio in the business, would even be relevant for most businesses. But it's valuable to these other companies and these investors. So you've seen a lot of companies come out, and the company we're acquiring at the moment, Mavericks, was created in that way, right? They were sort of spun out of Pan American Silver with some royalties in 2016, acquired some from Goldfields. They bought like 51 that were non-core from Newmont, did this with Barrick. They've done it with Kinross, and they've amassed, over 140 royalties and streams over that period. Contrast that with streams. In some ways, streams are a sort of an efficient way of replicating something like a royalty, but at scale. So, we've done, so the biggest we've done would be $550 million in 2020. It was the largest precious metal stream in the sector since we started. And that is streaming gold and silver on a copper mine in North Parks in New South Wales. So, multi-decade long mine, decades of life ahead of it, but it's a gold and silver byproduct on a low-cost mine with, a lot of life ahead of it, where it's just naturally symbiotic. It's worth more to us. We give them a low, competitive cost of funding, and we could write a very substantial check for them to continue to invest in their business. And then we also put things like scholarship programs in place to assist with their community investment programs and so on and so forth. But usually there's an upfront payment, just to directly your question, an upfront payment, in this case, $550 million. And in return, you're getting the ability to stream a share of the gold and silver in that mine, and with an ongoing payment. Say, it varies commercially. It could be a fixed dollar per ounce number for every ounce that's delivered, or indeed, a percentage of the commodity price that's in there. So in this case, say 10%. But what that allows you to do is participate of the life of mine, in that particular commodity. And the important thing for that to work is, compared to the other alternatives, you're always competing, not just with others in the space, but with conventional forms of funding. And because it's so long dated, if you think about going back to debt, I remember looking at a spodumene opportunity in Australia, which we were quite interested in. It's non-core. We focus primarily on precious, but really good bunch of operators building a mine out there. Spodumene lately is, doing pretty darn well, but back then, not so much. And this team, we offered them a streaming opportunity, which was low cost, very long dated. It's not debt. We take risks. So if they don't succeed, we take that production risk, which when you're building a mine is a really significant risk mitigant. But anyway, they took some pretty high cost debt as a single asset developer. And when, the lithium price was under pressure, the asset went bust. Whereas if they'd actually taken this form of funding, the second owner is doing well now, but because they recapitalized it and they built out. But you are betting the farm on those things. Whereas, if they'd gone down in a tough price environment, we would have essentially just gone down with them. They wouldn't have delivered to us. They only deliver when they produce, of course.
Yeah, like I kind of think about it is like, like a royalty is kind of like an option. So people that understand financial instruments or options, it's kind of like an option. So like today it's not worth much, but in 10 years time it'll be worth something. And you did a good job of kind of like mentioning that it's really an alternative way of financing. And and then that's kind of the benefit, is that when you're streaming, you're kind of sharing the financial risk of producing this commodity, which you're going to have some benefit out of it, because you're not getting the whole benefit, because the other person that's providing the streaming funding, they're going to get some of the benefit of that commodity as well. But you're not holding the whole bag at that time. And if things go bad, then you got to have the debt to kind of build this mine and do all of that. And so I think that's kind of the value of these things, is that particularly streaming, I think, it just kind of diversifies that financial risk involved in building a mine, and the operational cost of actually getting commodities out and all of this. So you guys are kind of partaking in that financial risk, and then based on your modeling, if you think you can do it for the right commodities, you can kind of get the payoff then as well.
If you think about it, and this is, you talked about competitive advantage or differentiation earlier. I think for us, firstly, coming out of a private setting, private equity capital is not free. No capital's free, but
Correct.
Our team actually has, over every single member of my team has significant equity in our business. We own over 6 million shares, and that was as a consequence of generating a return in excess of our cost to carry. And that sounds obvious, but it isn't necessarily. And I think when you look at it over time, and it was informed through our strategy of producing, like 70% of our ounces are really on byproducts on base metal and PGM mines, where it is not a core focus for that operator, but they have the margins and it has these sort of beneficial effects. So one of the misnomers we have sometimes is, it's not good for equity investors. Well, I'll give you a couple of simple examples, like Continental, which is a mine we invested in. Newmont brought us into this at a time down in Colombia, a place I'd done work in Billiton in 2000 on a privatization back there. They built this beautiful mine, multi-million ounce reserve, big land package. We were lost money in. We put, $100 million in streaming some gold and silver. But at the end of the day, there's these sorts of assets, I think at the time, within a very short period of time, it helped them finish the construction, build out, and they've been acquired by Zijin, who've then gone on and expanded the mine, and we participate in that. But what's beautiful about it, their share price traded a substantial premium because it was obviously under pressure for a partially built mine going on, and we took a tiny part of their revenue, but gave them the capital they needed to go forward on that. Another good example, which is playing out right now, we surveyed the PGM space in South Africa, which others in the space hadn't done. I operated there, and I was, LO's CFO in the Bushveld Igneous complex. I knew a lot of the guys there very well. My concern was you've got to have a great partner there, certainly a good empowerment partner in order to be successful. And the team at RBPlat were just like a sample set of one in some ways, because it was like the Bafokeng Sovereign Wealth Fund. They do an incredible job. The board, the management team, like the top drawer. These guys build schools. They build housing. They do great stuff. So like when the whole PGM space was out for, I don't know, 6 months with strikes, like they didn't lose a day because they just do a wonderful job with that. And so we approached them, as we do. Most of our deals have actually been bilateral. Like we do all the bank-led competitive stuff, but usually we're trying to solve problems for management teams as we see it, as people who used to sit in those seats, and we'll give them ideas. Usually they go nowhere, but occasionally they go somewhere. In that case, we were helping them replace high-cost debt from the buyout of their joint venture on Styldrift with Anglo American Platinum. Did the deal. I think at that time, we did a $145 million check. We streamed a gold byproduct on their, on the PGM mine. For us, it's a multi-decade good asset. We put $100,000 a year scholarship programs in to help the communities and give back to the mining space with engineers and geos. But, importantly, I think at that time, their equity price, their market cap was under $1 billion. We all know what's happened to, equity capital markets and share prices since. But with the takeover attention of Northam and Implats, they're, I don't know, $2.5 billion now. The equity investors are doing pretty well. And that comes down to your screening, the asset opportunity itself, and of course, the quality of, the management team.
So as a streaming business, what's the risk to your business, really?
There's several. So look, I think first and foremost, as you know, the thing with the mining sector is when you're essentially engaging in a life and mine relationship, who you're partnering with is the biggest thing of all. So of course, where you play, and our biggest concentration is actually Australia, by value, obviously a great jurisdiction, and then mostly the Americas. But it's really making sure first and foremost that you have done your homework, that you've got an operator in a jurisdiction where you know that relationship is likely to endure, because you're offering a very competitive cost of funding, and usually your shareholders will get rewarded over time through maybe further exploration, life extension, reserve replacement, and so on and so forth. It doesn't work very well, this model, if that doesn't play out.
Yeah, it doesn't work well if your operational partner, is completely torching their asset. Then nobody's actually getting anything out of it.
Correct. And if you can see up front from your due diligence that it's not just the obvious technical due diligence around tailings dams and the like, but if even just culturally how they embrace working with their communities and their workforce and the like. Business interruption is something that is a risk we share. So it's a benefit to the miner. We've invested and we've supported a number of mining businesses that, have gone from grasslands to going into production. These things usually take longer. We seldom underwrite anything that looks like what the management teams put out, because sadly, look at the data. I think 1 in 5 in the recent years have come in prior to the inflationary issues and supply chain, have come in more or less on time and on budget. 80% of them don't. So, that's part of the risk you're sharing in. But, I think, so that's always a big thing. You have to, in your underwritten case, really thought through the usual stuff that you would in mining M&A. And in some ways, it's a little harder because I've spent a lot of time in my career working on M&A and, the companies we discussed. But usually you are being given the keys to those assets. So you have the ability for self-help to some extent, when you own those assets. In this case, you're trying to see through at the management team, because you're essentially a passive but supportive form of capital. We have close relationships. We work with them. We'll provide ideas at times if we think that there's ways that they can enhance what they do. But that's ultimately at their discretion as operators, whether or not they agree with you or they see value from that exchange.
And I think that's kind of the point I really kind of wanted to focus on, is that you are a passive, to a large degree, a passive investor.
Yep.
Whereas if you were if you own like direct equity in the project, on the asset or something like that, you probably have a little bit muscle to kind of throw around, especially like a byproduct, right? Because that's not part of their core business.
I think that comes down to one of the big differences in stream financing versus, say, royalties. Royalties usually is something struck a long time ago, and it is what it is. Whereas you can highly customize and work with the miner to put these in place in a sensible way, including things like, what are your commercial protections? What are your information rights?
That's a good point.
So you really actually have more interface with those guys. And even so, my first deal when we started this business was 8 months or so after we got going. So we're building the team, we're finding office space, you're building a website, and you're trying to get deals done and open bank accounts. It's harder than you think when you're starting out. It was a mine called Cerro Lindo in Peru. We streamed a silver byproduct on a VMS style deposit in Peru, a few hours south of Lima, which is copper, lead, zinc is their primary product. The appeal there was just how low cost and how low capital intensive this business was, and how it could continue to replace it. And it's a byproduct. So to your point, they didn't really even do a lot of reporting on it at the time. It wasn't a core focus for them. So it's just naturally symbiotic. But we had a view when we did that there was a way to better exploit the overall resource, that there was opportunity there which would benefit them. And we did some. We spent $40,000 or so at the time just on the study. We shared it with them. It's like, here's some free consulting, if you will. If you think it's interesting, then let's go with it. And in the beginning, it had no purchase. But after a while, the team sort of looked through it, saw the merits, and really embraced that, and it's gone well. And so I guess what I'm pointing to is, one, there are commercial protections. Like, we want to make sure very often that businesses are not going to take on too much debt. As much as I care about return, I don't want to own and operate assets. That's not the model. So we don't want to be parasitic. We want to make sure that these businesses in distressed pricing scenarios on a year-by-year basis, you want to just understand the risk. You want to ensure that they've got the liquidity, and that you can work with the guys to ensure they don't take on too much leverage, or that they've got the buffer to deal with the unforeseen. And I also recognize that every management team is unique. Like, investors often look at the mining space and miners as monolithic, and they'll say, well, those guys could have raised debt, because they're right. They could easily have raised debt, but just as a cultural point, they didn't like a lot of debt, and they wanted to diversify their funding sources. And this was a form of natural arbitrage. It's worth 3 or 4 times EBITDA. It's worth more to us and our investors. So, I think we found a lot of opportunity, plus the relationships going forward. And when you're like, recently, it's a small investment, but we helped. We got a small investment in Mongolia with a group called STEP, and we helped bring 9 or 10 of the local delegates out to Canada. Worked with a university here on a couple of weeks just on generating some environmental best practices, help them experience that so they can then take that back and implement it. So that's sort of value over and above just, writing a check.
Yeah, and I think that's a good point, in that it's in your best interest to actually create a relationship that's symbiotic. You can obviously be completely passive, or you could be completely parasitic if you really wanted. Depending on what type of partner you have. But it's really in your benefit to kind of help your partner, because ultimately your financial future benefit kind of ties to them actually doing as good a job as possible.
It entirely is. But if you even look at it on a simple business school level, like, you think, is it a single game or is it a repeated game? If it's a one-time game, you want to maximize profit in that one-off event, then maybe you behave in a way that is just, you have a winner and a loser, because you only get to play the game once. Guess what? You play this game time and time again. You want to be the best version of yourself. And we do get business referrals from others. often seen, particularly on single asset situations, a lot of the CEOs in these businesses are really guys who were former GMs of mines. They're good operators, but then maybe don't have a lot of technical or commercial sophistication. And sometimes the CFOs are not guys who are, they may be good accountants, they're good at reporting, but maybe they haven't had a lot of that experience themselves. So just trying to help them, we spend time just educating people where you'll provide proposals and they've got to help think through, even their advisors at times, how do I think about this, the way I was talking about at Barrick earlier, between debt, equity, other forms, convertibles, and of course, this form of funding. And it has to make sense compared to those alternatives. And you need to actually help them understand the merits of that.
One of the, I guess, things that I wanted to kind of talk to you about is that, like recently it seems like that there's a lot more royalty and streaming companies. Do you care to comment why? Like I guess I have kind of some opinions on why, but I'd be interested to know, as someone that's sitting on that side of the fence, why do you think they're becoming more and more prevalent?
Yeah, it's an interesting one because we get this question in a different way from investors, and that is, this looks like it's getting more crowded and more competitive. That must be tough. But I think I go back to the founding idea of this business. So, it was really that there's not a scarcity paradigm here. I'm a huge believer in this energy transition. I love cars. I've got an old 68. I do that. But at the same time, I've been driving EVs for a decade. And as a consumer product, the future on electrification, consumer adoption, and the metal intensity that is going to need to deliver that future is a massive opportunity for the mining sector and investors. It may not happen in the next X months, but it's there. And I believe the sort of funding we're talking about can really be part of that cocktail, really to help enable that future. So, it's just one of those environments which I think when you then say, okay, what does that mean when you think about the competitive landscape? We go back to founding in 2016. One, I don't think there's a scarcity paradigm. I think there's more opportunity if you're patient than there is capital available, actually. Then I think about, how do you segment the competitive space? When we started in 16, I'm sitting in Toronto. The bankers in Bay Street, the narrative was, there's not a lot to do here. You've got these three big companies, they're beautiful. You're never going to compete with them, particularly with private equity. There was a scarcity paradigm. And all the good deals have been done. And you're going to have to go to some really risky jurisdictions if you want to make money. And that's fine. But that's not how we view the space. And our history has shown that I think we were right. Like we've looked at over 600 opportunities for so far 80 assets. And after we hopefully close the Mavericks deal in January, we'll have, 228 assets in the portfolio. So there's been a significant, and we haven't had to violate the model in order to achieve that. So it's been important. But at the time in 16, when we started, besides that narrative, we also saw there were some new entrants coming out of Asia and elsewhere into the space who no longer exist. So I think your team, how you compete, your networks and all that actually do matter, particularly at the big end where we've chosen to participate. I don't feel that the competitive dynamics at the space that we play in are any more onerous than they were when we started 6.5 years ago.
Yeah, okay.
But to your point, I think it's objectively and empirically true that there are a lot more guys that are doing this. And I think that's where we viewed the smaller end accumulating existing royalties from mining companies, maybe doing a model where people generate their own royalties on land packages. There's businesses who do that quite well. That's a different model. And we've seen a lot more do it. I think the barriers to entry are lower. I think the recognition of various mining companies that there is value to be having stuff they didn't even know they had or that they've got very little value on has been an enabler of some of those new entrants and new businesses, or it's helped some of those businesses grow. I think that's a lot of that story for just the sheer number that is sort of emerged in the last while.
So it's interesting that, like you kind of build this business around like 2016, 2017, like that era. I guess my kind of hypothesis about why, there seems to be more streaming companies is because, that was an era where, mining finance really kind of dried up. Like there wasn't a lot of capital available for people that wanted to build mines or to do anything. So here's my kind of thing. And I'm, like that created this kind of space or this niche for private equity to kind of come in and say, well, we can be an alternate source of finance in a different way. And yeah, and I think that kind of led to the streaming model to kind of develop, because on one hand, you had all of these companies that wanted to be operators, but they just couldn't, I think, access the amount of capital that they could. And that created, I think, this nice space for private equity to kind of come in and say, well, we're not going to completely replace the banks that are financing mining projects, but we can be an alternate source in a different way that they can kind of finance projects. Do you think that that's part of the reason why there has been this explosion of these type of company?
A couple of comments on that. The first is, bear in mind, we did our first deal in December 16. I'd say we would, until very recently, we were averaging, say, 3 deals a year, a few $100 million deployed at a time, and that cadence was pretty steady. So it wasn't as if there was like this big flush of deals in, say, 16, 17. And then, I think what we found is the nature of the deal flow, some ebbs and flows. Like early on, I think there was sort of more balance sheet repair for some businesses, replacing high cost debt and the like. There's always mine development stuff, but you've got to diligence that well. And I think recently, in particular, with inflation and supply chain constraints, it's not for the faint of heart. You've really got a lot of the 43-101s and the studies out there are backward looking and they're stale. You've really got to make sure that people have factored in the right stuff and you underwrite the right thing. So we always see those opportunities. We've done a bunch of acquisition financing alongside miners where they're looking for competitive funding as part of a funding cocktail, but they want a partner who's not going to jam them. They want someone who can get it done, and execution certainty is there. So there's always that mix. And then there's just this sort of natural arbitrage, like a group that has maybe a use of proceeds, it's non-core. They might have a royalty portfolio, or there's a stream on a byproduct or something.
That's right. And they just don't value it as part of their core business. So, so it gives the opportunity for someone else to acquire it.
Yeah, so it's sort of evergreen. I mean, you have these ebbs and flows, and I feel as long as you're not drawn into doing deals for the sake of it or growing size for size sake, you've got to be disciplined. There's a lot of opportunity. Like our pipeline now, I actually don't think I've seen it busier ever.
Is it harder for you to do deals? Has it become easier for you to do deals? Like, is there a market cycle that impinges on your business model?
You would think so, right? I'd say yes and no. And why I say yes and no is obviously if you've got an abundance of cheap capital, firstly, you don't see that very often in the mining space. I think those windows they're there and then they're kind of narrow. And I also feel, just look at the world we're coming into. The era of free money seems to certainly be under threat, right? So I think that's certainly one thematic that is pretty difficult. But if you just play this forward, like we found periods where there is a lot of let's say cheaper equity available or lower cost debt that's available. It may coincide with, let's say, a high gold price. And if someone's trying to build a mine and it's polymetallic, and there's a lot of polymetallic ore bodies out there, this doesn't necessarily displace, but it complements. So there'll be, some equity, there'll be some high cost debts, there'll be some or senior secured debt, there'll be a stream, maybe there'll be some additional debt. We've done a lot of financing like that. And even if you think about it just from a risk point of view, there's a cost element, but particularly on developing or ramping mines, if you can stream a byproduct, and you've got capital in that stack that is super patient, and if you don't deliver the mine on the how many years you said it would take place, and it's a year later or it's never, the streamer bears that risk. Like you carry that risk as does the equity holder. Whereas if, of course, you've got debt, you either trying to negotiate at some cost to push out those repayments, and you've got maybe an interest holiday, but it doesn't come free. You have to think about your funding stack in a very thoughtful way, and it really has a role to play there, I believe.
And so this is, I think, one of the kind of the first points you made, going back to that point, in that, like one of your differentiators is that, like your financial backers are patient. They're happy to wait that kind of long cycle. They were wanting something like, quick in and out. Like I think this would be the worst model for them in that sense, because, like you're going to have to transact when you don't want to, and then it's not the right kind of arbitrage opportunity and things like that.
Yeah, that's true. Well, obviously we transitioned to the Toronto Stock Exchange. It shows you the state of the equity capital markets, going to your earlier point, because we listed in May of 19, and at the time, it was the largest mining IPO in Toronto in like 10 years and the largest precious deal globally or IPO since 2008. And I think that says more about the state of the mining sector's IPOs than it does necessarily about our own. I was surprised to see that. But what it does mean is obviously we've got a growing and more diversified set of investors. There's no monolithic investor. But I certainly know in Elliot's case, for me, they've been the perfect partner. Their time horizon is an important facet. But for them, they looked at different ways of investing in precious metals. Like you hold bullion, that has a cost. You hold ETFs, it has a cost. You hold equities. The sector often has a habit of stepping on the garden rake when it comes to capital allocation or so. So there's risk in there. And they really admired Franco's impressive track record, but wondered, could we build a business that didn't have the oil and gas element to it, was very precious focused in execution, and could compete and build the next Franco as an idea. And part of the appeal is once you've created the right sort of team, the right portfolio, like times like this, we don't get margin compression. Like our G&A is pretty constant. It's not a high overhead business. Our cash margins are 90%. We have no debt. And we're generating like pro forma now with the Mavericks deal, just around 150 million of free cash a year. And then with our dividend, that's pretty easy to service. Like our current dividend's only 30 million a year, and that's the highest dividend yield in the space. So it's a highly cash generative model, very defensive when it comes to risk. And you can't really create a mining company that I've seen that has the same level of diversification that you can create here just by virtue of the sheer number of assets that you can incorporate. So there's a lot of these very defensive elements that I think explains, the sort of intrinsic valuation potential.
One of my hypotheses about why this sector I think has grown is kind of like how like this sector can allocate capital, I think, differently than what banks can, and or what even mining operators can access. Like the other part I think is really around what you're kind of talking about, is that the capital efficiency of these companies, like is not something that like mining operators could could kind of handle. Again, if you think about a mining company that's like creating say $1 billion every year, or even like in your case $150 million, like that's a fundamentally different operation, because there's a couple of hundred people, and they got all of these kind of issues, and the operational expenditure is quite high, and all of those things. But for look at Franco, like, it's a whatever, $20 billion company that's run by like 50 people. Like
we were 13.
Yeah, that's right.
Exactly.
That I think is also kind of the part, is that, if you're talking about like how to be capital efficient, A, you can be that, but B, you can also diversify your risk by having your money in all of these different assets rather than just having it in one asset, and you're wedded to that asset. The commodity price of that asset, everything relating to that one asset.
Absolutely. And you see it Xstrata, we used to talk about diversification by commodity, country, asset. Here we've got our biggest concentration pro forma would be North Parks, which is say 24%. You'll see a similar thing in even Franco and say Wheaton as the two biggest in the space. Like Wheaton's got Salobo, Franco's got Cobre de Panama. That's like nearly a third of their assets. So they've got this one chunky asset, but then the rest of the assets are below 10% when you look at it by value, and there's a lot of them. I mean, we'll have 29 operating assets of say 228. So there's this big bucket of optionality that comes along for the ride, short, medium, and longer term. But at the same time, and a lot of diversification, but those cash generating assets really are quite diversified. And then, same thing by region, you really do have that. And then we are concentrated by commodity and by design. So, 75% will be gold, and it's only, I think we're 93% will be gold and silver as sort of a precious investment vehicle, and the rest is really kind of copper and nickel.
Is there a reason why you are so concentrated in precious metal? Is it just because they, like other commodity classes have like nickel, it obviously has a great year once, but then it'll have.
I know, it's the reason they call it devil's copper. It's tough.
It's a hard commodity to build a business on if you're really kind of setting it up.
Boy, you can make money when it's going. It's true. Yep. Look, I remember like my first week in the CFO seat at Barrick, and thinking, okay, I've lived in the comfortable maybe not comfortable, but I've lived in this sort of familiar background of supply and demand of bulks and base metals. And, you spend a lot of time with your macro assumptions, looking at the various sources of supply that exist, where they'll come on, where the cost curve is. It's all very nice. And I try to understand with all the experts I could find the best I could before actually really starting how to think about the gold space. And my conclusion was simple. It's like, firstly, nobody really knows. But secondly, supply and demand is not as much of a factor. And thirdly, it's really a currency, right? And so, what's happening with interest rates and certainly the US dollar is really the factor. But when you then look at gold over time, it is something that's had a store value over millennia. It is something when these businesses have traditionally over time attracted a premium multiple. And if you embrace that, and embrace it in the sense that, go back to how we thought about competing, I feel this model works best when you can enable businesses that generate a severe societal need for things like energy transition. I think the mining sector as a whole we've got a better job that we have to do to engage with people who enjoy the products every day, who seem to have an anti-mining bias, but really don't understand that this stuff doesn't magically appear out of anywhere. Like, there are people who do incredible work to deliver these damn products. So, so our form of funding, particularly if we're able to provide, that sort of patient, long-dated, low-cost funding, and it's on a byproduct in particular, it provides people who are looking for that precious exposure, who can diversify themselves if they want to get some of that other exposure, stick to the knitting, do it right. Like, guys will say to us, well, why don't you go, you've done stuff in nickel and copper and other businesses, why don't you do more nickel and copper stuff? Well, I think the best thing I can do to help nickel and copper businesses is, stream their byproducts, because otherwise I'm competing for their primary product ultimately. And we can do that, and we have done some of that. But the highest and best use of the capital and the way you can create value, I think, on both sides is the way we've sort of chosen to compete.
You mentioned a little bit about kind of the retaining of staff, and you mentioned that it's kind of an issue that the industry kind of faces. Do you care to elaborate a little bit about why you kind of made? It seems like a throwaway comment, but I'm going to say it's a throwaway comment. But what was your nature for kind of saying that?
Look, I think in normal times, the sector has been chronically, certainly underserving its needs when it comes to talent requirements. I think we've got a much better job if you're looking, I can't think of a better thing for a generation that is looking to deal with the climate challenge and, find a career of purpose. There is so much opportunity in this sector for us to be able to do that. When you start a business and you pay taxes, central government sitting in capitals don't necessarily do a great job of actually allocating benefits to remote communities and helping uplift them. Whereas mining companies, when done right, really do that very well. So I think there's so much scope to bring fresh ideas, fresh thinking, new talent, but we don't, whenever there's a tailings event or there's an unsafe event somewhere, that becomes the poster for bad things in the sector. And people don't necessarily see all the good stuff and hear the stories and see the opportunities here. I think we really have to do that. Now, I think we also have a kind of a generational cliff that is coming from a talent point of view, and it's coinciding with a time where we have I think we're on the cusp of a lot more demand for the sort of skills that will be needed to meet the future supply, if you believe in the energy transition and decarbonization and the metals needs for those mines. So I think there's a severe need. There really, really is. And it's not just, the universities, when I studied back in the day, there were scholarships more readily available, to fund these things, the sort of education programs. Universities are just churning out fewer and fewer, and then mining companies and others providing maybe less opportunity to provide the experience and the growth that's needed, I think, to create the next generation of talent and leadership. I think it's an acute problem for the sector.
I mean, I think the points you made are, I think, are fantastic in that, at a time where we as an industry should be as outward facing as possible to try to convince people about what we're doing and how we could be part of the solution. Well, I think we are becoming far more internal in how we actually talk. We don't seem to want to talk to anyone because of fear of getting harassed or colored by like some social value or ethical structure or something like that. And like at a time, I think we should be doing as much external kind of face communication as we should be doing. So it's a real weird hole that we kind of seem to have found ourselves in, where we can't seem to get out of it.
I agree with you. I think there's an opportunity for sort of more aspirational, outward, sort of visionary leadership to be able to help make that case. And it's not to say that, I mean, it's tough running mining companies, right? Guys have got a lot of things to deal with. But I think as a collective, we've got to find a way to do a better job of that and really make that case, because it feels like we're playing more defense than going on offense.
Completely. And so just as a out of interest, why did you get into metallurgy, which is how you kind of started? What was the seed of that?
Yeah, it's funny how things come about. Look, I'd say my hero growing up was my grandfather. He's just an incredible guy. He was actually city engineer at Johannesburg for a while, and this amazing guy. And I used to work on.
So do we have him to blame for the layout of Johannesburg, or is there someone else we should blame?
Yeah, no. But at a time when there was a lot less intense, like he was doing bridges and infrastructure and all that. I guess he was a civil engineer. Worked, did his thing with the Royal Engineers in Italy and North Africa. He's just had a very interesting life. But at the time I wanted. I used to spend time working on cars with them and tinkering. It was just a very formative experience. And I wanted to, originally I thought I was going to be an electrical engineer. I spent a lot of time tinkering with stuff and, breaking things and having a lot of fun. And it was just before I had to make my sort of career decision. I went to careers evening. There was a visiting group out of the Department of Metallurgy and Materials at WITS who their whole focus was on the sort of materials innovations that were going to enable the next generation of technology. And they looked at the space shuttle at the time, which really captured my imagination, like the heat shields and the tiles, the metals and things that were needed in order to make that technology possible. Really was just, to me, quite fascinating. And so, that's what got me into metallurgy. And I think the beauty of it, and I think back to my class now, though, I'm one of the few guys that is still doing anything sort of mining related. Most have gone on to do everything from nutritionists to, bankers to you name it. But I think it is a wonderful grounding, those sorts of programs, and a great thing at the time as well, at that time in South Africa, to be able to be given line responsibility at a very young age, just from a management point of view. A lot of good experience on offer.
So, Shaun, towards the end of our interview, we kind of always ask our guests two questions. So the first one is, what is something, it could be an idea, a behavior, that you think needs to die in our industry, something that we need to jettison out of the industry?
I actually think it's something we touched on in our calls, and I put it on different layers, and that's this sort of bunker silo mentality at times. A lot of the companies I've gotten into, won't mention the names, but things we've taken over or we've helped restructure, I've been pleasantly surprised. Well, actually not pleasant. It's not been pleasant. Like this idea that even within corporate offices, you've got these bureaucracies or hierarchies that, create these silos around different functions. There's this strong functional concentration. And I think part of the secret sauce with Xstrata and the business that I've really built here is around trying to actually provide people with a broader scope to be able to actually maybe step away from their narrow job descriptions, to actually think on a more holistic level, to work together. And I just think it lends itself to better engagement, better decision-making at the end of the day, better decisions. So we've seen that within mining companies. And I think going back to what we just discussed, I think as a sector, I don't think we don't sustain the investment in people and in innovation that's needed to solve the problems for declining grades and greater complexity and environmental challenges. I think the future is probably going to come from experience and knowledge in the sector with disruptors, like we saw with the aerospace thing, going back to earlier points, like NASA, the Russians, whatever, couldn't land a rocket, on a little pad and do the stuff that, ultimately Musk did as a risk taker who embraced failure. But got people together to do that and to essentially change the cost structure of that industry by an order of magnitude. I think it's going to probably be something like that will be needed from a more solid lens to actually out of necessity, out of need, that will probably disrupt our sector at some point. So anyway, I think the more we can break down those silos at a site level, at a corporate level, and as a sector, I think the better it'll be for all of us, and the easier it'll be to attract talent.
I think that's an excellent point. Conversely, and last question, what is something that you think we need to maintain in our industry? Something that you think is kind of fundamental to our DNA that we shouldn't forget.
I think that that sense of just problem solving, adventure, and sort of that can-do attitude. Because you think about it, as much as I've just sort of shared the thing I think shouldn't go, but it's never ceased to amaze me the incredible level of dedication and capability when you go to mine sites on the top of the Andes, up in the subarctic, some pretty hostile environments, the deserts in Australia and elsewhere, and the ability of people to really, with a high level of goodwill. I think most businesses want to work with their local communities, do the right thing in order to overcome really quite difficult problems at times to extract these minerals. And I think there's that can-do attitude and that capability that exists not just in one region but all over the place. I think is something we need to do more to harness and tell that story and create a viral opportunity, hopefully, for the space.
This is a theme that often comes up on our interviews around that, if you think about an industry that would have a high proportion of people that are intrinsically motivated to do the work, like our industry, like I assume would probably be at the top end of that kind of the number of people that are intrinsically different. You don't hear of like accountants. I have friends that are accountants and they go, mate, I go to work, I walk away, and that's it. I don't sit there dreaming about spreadsheets or things like that at the end of the day. The job is not something like that's intrinsically motivating for them. But if you're talking about people that are going to kind of the Andes or going to even your thing, going to Colombia, going to all of these, there's got to be some kind of fire inside people that kind of drives them to go to all of these places. And I think that's something that probably the industry doesn't highlight a lot of, is that that in order to be that crazy person that goes and builds a mine on the mountaintop, you got to be a little bit crazy, like that pioneering kind of spirit to go, why not build a mine at 4,000 meters or whatever we need to do, right?
Why wouldn't you want to live an interesting life, right?
That's an excellent story. That's it, Shaun. We're pretty much at the end of our interview. Thanks a lot for coming on the show. This is a great chat.
I love the way you took the conversation in natural directions. That was great.
Cheers.
No, likewise. I really enjoyed talking to you. Thanks so much. Cheers.
This episode of Exploration Radio was brought to you by Ahmad Salim and Steve Beresford. Produced and edited by Sean Jeffrey and recorded remotely in December 2022. Exploration Radio is supported by the AIG, the One-to-One Group, and the Assay. It is an official media partner of the 2023 PDAC conference. Until next time, let's keep exploring.